Over the coming videos, we will introduce you to some important terminology that you will be using throughout your trading education and put the theory you have been introduced to so far into context. You can refer back to this video and the article that accompanies it whenever you need to clarify something. Are you ready? Let's go. First of all, let's introduce you to the trading platform. The trading platform is a piece of software installed on your computer, and it is effectively your command center. You will trade using this software by using it to tell your broker what you want to buy or sell, how much you want to buy and sell, when to take your profit if the trade goes well, when to take your loss if the trade does not go well. We will teach you how to trade mostly using the MetaTrader 4 platform because it is robust and user-friendly. However, keep in mind that different platforms are used by different brokers. Most trading platforms offer similar functions, and you should find it relatively easy to adapt to each of them. You can see that this trading platform contains a chart. This is the visual representation of the price action, and we use this for our analysis. It is here that we identify trading opportunities. The vertical axis on the right-hand side is the exchange rate or the price of the currency pair. The time is along the horizontal axis. These are Japanese candlesticks. They are a method of illustrating the price movement, and they tell us a certain amount of information. First of all, the candlestick represents a period of time. If we refer to a 1-minute chart or candle, what we mean is that each candle took 1 minute to form. After 1 minute, the candle will finish forming, and then a new candle will begin. On the other hand, if we use a daily chart, this candlestick will take 1 whole day to form before a new candle begins. Candlesticks can cover almost any time period from 1 minute to 1 month. The candlestick has a body that shows us the opening price and the closing price for that period. This candlestick was going up. At the beginning of this period, the price of the euro-US dollar was 1.4000, and at the end of the period it increased, resulting in a final price of 1.4080. The color of the candlestick changes when the price moves above or below the opening price of the candlestick period. Any color can be used, and the color is set by the trader depending on their personal preference. Here in Trader Mode, we use blue candles when the price is above the opening price of the candle, and orange when the price is below the opening price of the candle. So if a candlestick is blue, the price can go up or down, and the candle will remain blue as long as the price remains above the opening price. It is only when the price moves below the opening price that the candle then becomes orange. In the same way, this candle will remain orange regardless of the movement of the price, and will only change to blue if the price goes above the opening price. If the candle finishes with the opening price above the closing price, then the candle will stay blue. Similarly, if the candle finishes with the closing price below the opening price, then the candle will stay orange. Curious about these sticks. They are called wicks, and they tell you the highest and lowest price during the period that the candlestick represents. For example, the candlestick just reached a new high, and you can see that the wicks remain after the price goes down again. So you can see where the highest and the lowest price were after the price retraced from the low and the high of that period. We're going to trade currencies, right? When you think about the price of anything, it is pretty easy to grasp because there is a single price. For example, when trading oil, the price quoted is the price per barrel of oil. When trading gold, the price quoted is the price per ounce of gold. When it comes to Forex, however, we also refer to just one price, only we have two different currencies, a currency pair. It can be confusing in the beginning when we think of one price for two different things, but we'll explain. When we trade currencies, we are buying one currency with another. For example, if you want to buy euro, it will have an exchange rate in relation to other currencies. This is the price of the euro. So if you have US dollars and you want to buy euro, you will buy it with a certain amount of US dollars. We refer to a currency pair when we are looking at the exchange rate between two different currencies in conjunction to each other, and so the exchange rate is the price. Did you notice that the prices we use have long numbers? Well, in Forex, we will use numbers with 4 decimal places, like 1.4000. The last digit is called a pip. If the price goes up by 1 pip, it will increase to 1.4001. Many brokers even include a fifth number called a fractional pip or pipette, so they publish the price as 1.40010. Do not be surprised to see 5 figures after the decimal when you are looking at the price of the currency pairs on your chart. So let's say the price of the euro to US dollar is 1.4000. This means that the cost of 1 euro is $1.4000. If the price goes up by 90 pips to 1.4090, we will need $0.0090 more dollars to buy 1 euro. When the price of the euro US dollar increases, this means that the euro is getting stronger against the dollar. If you think that the euro could get even stronger, you may decide to buy the euro dollar in order to sell it again at a higher price. This is how we make money in the Forex market. So when you are trading, you will simply look at one number, which is the price on the vertical axis of the chart on the right-hand side. When we are looking at currency pairs, the first currency in the pair is called the base currency. It always has a value of 1. The second currency is the quote currency and is the amount needed to exchange into 1 unit of the base currency. When we refer to a currency pair, we are now referring to one single price, and we can observe the price as a single entity. This allows us to buy and sell a currency pair, as if we are buying and selling anything else. We will learn to trade these currencies soon. Be patient. Just one last thing before we get going. You need to have in mind that you are trading with money and you need to protect your trading capital from losing trades. Here is where the concept of risk to reward ratio comes in. This is essentially the ratio of how much we are risking on any single trade, if the trade does not go in our favor, to how much we make if the trade does go in our favor. So, if we risk $10, then this is the amount of money we are prepared to lose. If the trade does not work out, we know exactly how much money we are risking and will not lose more than $10. If we are looking to gain $30, then this is the reward we are seeking. The risk to reward ratio is then 1 to 3, because we are risking $10 to gain 30. So when trading, you need to have a clear risk to reward ratio in mind. This is directly connected to your profit target and your stop loss. Your profit target is the price at which you will exit the market and take your profit. You ascertain this before you actually enter into any trade, so if the trade goes well, you know how much money you will make. You must also know where you will place your stop loss. A stop loss protects you if the trade goes wrong. Let's say you entered into a trade and the trade does not work out and you start to lose money. As the price keeps going in the opposite direction to your trade, you could in theory lose your entire trading account. A stop loss is an order that will automatically close the trade once it has reached a point where you consider the loss unacceptable. Let's practice trading in a scenario where you think you are going to profit from buying the euro-US dollar currency pair. The market direction is going up. You believe it will continue going up. Don't worry, we teach you how to ascertain this in our learning path. The price is 1.4012. You decide to buy because you think the price will continue going up. At this moment, you are a bull. No offense. This is the term that describes a trader as a person who believes the price will go up. Since the market price is going up, it is said that it is bullish. Set your stop loss at 1.4000 and your profit target to 1.4080. Again, we will teach you how to set stop losses and profit targets further on in the learning path. You are in. You have entered a position. Because you are buying, you are entering what is called a long position. The price is going up, it is bullish, and you are making a profit. Good. You are doing well. You are approaching your profit target and you will close your trade once the price reaches it. It is now 1.4080, and so you close your position. You have clearly made a profit and you sell and exit the market. You are out now and have made a profit of 68 pips. Congratulations! But what happens if you lose? Let's visit another scenario where we experience a losing trade. The price is 1.4012 and you are a bull because you think it will continue going up. So you enter a position. Because you buy, you have opened a long position. Okay, the candle goes up to 1.4025, but oh no! The price is going down. The price has reached 1.4009 and you are now making a loss. Do we care? Of course not. You have a stop loss at 1.4000. At this price, you can let your trading platform close the trade automatically when it reaches the stop loss and exit the market, closing your position. You are out. You lost 12 pips, but not too much thanks to having a well-set stop loss, a reasonable risk-to-reward ratio, and above all, following your common sense. Now we'll take a scenario where we think the price will be going down. The Euro-US dollar pair is at 1.3995 and you think it's going to continue going down. Now, you're a bear. Traders who think the price is going down and intend to sell are called a bear. You can make money if you sell the euro dollar. You may think, how can you sell something you do not yet own? The answer is that the broker has a mechanism called short selling to lend you a currency that you don't have but would like to sell. The exchange process occurs behind scenes and you don't need to worry about it. You only need to click the sell button. So let's trade again. From here the process is the same as before. The only difference is that since we're selling Euro-US dollar, it is in our advantage that the price is falling. In this case, the US dollar is getting stronger. The price now is 1.3993. You set your stop loss at 1.4015 and your profit target at 1.3910. You decide to sell and enter the market or open a position. In your case, a short position because you are selling. You are considered a bear. The price went down to 1.3910 and you close your position because you have reached your profit target. Close your position and exit the market. You have made a profit of 83 pips. You are now prepared to enter the world of Forex. Of course, there is much more to trading than what we've just covered. Having a good understanding will be crucial to making money, and our learning path will build upon what you have learned in this lesson and enable you to become an experienced trader.